getting into. Do our clients know how good what we offer to them is? Because if they truly did, I believe more of them will be putting a heck of a lot more money. So I think hopefully today's training helps you with that. So I want to stop talking and I want all of you guys, he can't hear you, but he can feel you. He feeds a lot of people's energy. I believe he's one of the best trainers in all of GFI, one of my best friends in the world, one of my favorite partners. This is a guy that I believe his team is due one of the biggest explosions in the industry. So I want you guys to please help me welcome the man himself, Mr. Austin Harwood. Austin, can you hear me? And
Yes, yes, yes. I can hear you. Thank you. Thank you. Appreciate it. Hey, good morning, Lion Star. How we doing? It was funny. I was just hanging out with Randolph yesterday, and he was like, dude, like, I'm not just saying this because I'm here with you, but like that call you did for my team was like the best I ever heard you. And I was like, oh, really? And he's like, yeah, like I'm serious. Like I've heard you speak a lot, but like that was the best. And I was like, oh shoot, now I have to do it on Monday. Right. I hope I can live up to it. But here's what I told them. Here's what I told them. Right. I said, you know, the difference, because I've done that call for like Legends based shops. I've done that call for like some of the Lion Star based shops. I said, you want to know why your call was the best? And he's like, why? And I'm like, because your people had the best energy back to me. I can only see a certain number of people on my screen, but when people are like laughing and nodding and all that, like I get more fired up. And then like, I just like stuff starts flowing. And then he's like, oh yeah, that's good. I was like, dude, you were laughing. Jane was laughing. Amanda was laughing. I was like, it was great. Right. That I was just going up. So here's the point. If today's training sucks, it's your fault, right? It's your fault, right? If today's training sucks. But anyways, let me go through here. Let me see who's got some good energy here, because I can only see a few people. Let me see who's got some good energy. All right, of course, Terry. All right, Lou's always laughing. Okay, all right, good. Okay, I got some good people on here. All right, I think this is going to be good. And by the way, buckle up, because I have like 117 slides. Just kidding, but it's about 35. It's a lot to cover, right, in this next hour. And I'm going to be jamming because I just had a Celsius, right? I should get paid for this. But anyways, I'm going to be jamming, right, because I just want to bring you guys my best. And Mario asked me to cover a couple things. And those of you that know me, even back from the practice company, know that I love IULs, right? They're one of our flagship products here at GFI. And for those that don't know, I brought family banking to that old organization, right? Literally, like, and I'm not looking for this, but if you want to give me one, here you go. But I did bring family banking to that old organization, and we did do what Mario said. We increased our premiums. We went from 43 million a year, right, to 233 million a year. A lot because of this. Right. So I want you to be thinking like, where's your cash flow at now? Where's your production at now? Where's your team's production at now? How would you like to go 5X in the next 6 months, the second half of the year, second half, best half? That'd be pretty awesome. Right. That'd be pretty awesome. And it was my wife's birthday on Saturday. So happy birthday, honey, right? That was pretty awesome. That's why I had to throw in the nothing would make me happier than so I bought her nothing, right? And that was a joke from the weekend. All right, good. No, I did treat her well. Don't worry. All right, good stuff. Well, let's get right into it, guys. And there's gonna be a lot of screenshots you're probably gonna want to take. There's gonna be a lot of maybe like phrases, word tracks that you're gonna want to write down during this whole process. And I'm very excited to get into this with you guys. So here we go. Buckle up. All right. First things first. Can everyone see my screen? Give me a thumbs up. Everyone can see my screen. We're good. Awesome stuff. Thank you. And this is our flagship program. We talk about tax advantage wealth accumulation strategies, and some of you know IUL, some of you don't know IUL, and that's fine. I got my chat up here too. So, once again, the energy in the chat and all that good stuff. And I'm going to be asking for participation. If you know how I train, right? I don't want to just talk at you, right? I want to involve you. Okay. But this is my number. You can follow me on Instagram. You can use my little content to send out to clients or business partners or whatever. Like, we're all just doing this to help you and grow Lion Star and make sure that we're the best and all that good stuff. So if you can leverage a little 20-second video or 60-second video or 90-second video and it helps you with a client or helps you with a teammate, then just go for it, right? Just go for it. GFI, go for it. All right. So 3 things IULs can be used for. 3 things IULs can be used for. And some of you are only doing 1 or 2 of these. Okay, so that's the point of today's call, right? Is to make sure that we know what all the options are. Yes, it's one product, right? But it's multiple strategies. One product, but it's multiple strategies. So the first thing is insurance protection. What is IUL at its core? Life insurance, right? It's a life insurance policy. Okay. Now it has some amazing benefits. And we're going to talk about that, but think about insurance protection, consistent contributions. They're on a budget. Maybe they're saving $100. Like Mario said, I'm not going to take you to Pebble Beach for $100, Mario, but, something like that, right? $100, maybe $200, right? It's target contributions. You're getting what we call full target. Well, I don't understand what that means. Talk to your EMD, talk to your MD, but we're going to cover some of that stuff. It's what we get paid from. The second use we have is what most of us used to do at the practice company, what we call tax-free retirement, supplemental retirement, right? Usually this is like someone has a lump sum, someone's redirecting maybe their employer plan through work, like they're redirecting partial or full contributions there because they see there's more benefits with this. We're going to talk about that as well. They're more saving for long term. You're maybe saving 40 years, 30 years, 20 years, 15 years, something like that. But you're going to be using this as a tax-free retirement. Tax-free retirement. Okay. And then the last one, we're also going to be talking about this, is infinite banking and family banking. Have you seen that's also on our little 10 boxes for our client solutions, right? That's one of them on the top right. It says infinite banks and family banks. And we're going to talk about that. That's where you're max funding it. Maybe you're doing a limited time frame on your contributions. You have early cash access. Some of the things Mario talked about, being able to get to this money tax free, right? And grow it. And I always ask people too, like with index strategies, I say, hey, just curious, if your money could go up, down, or sideways, which one of those would you eliminate? If your money could go up, down, or sideways, which one of those would you eliminate? And what do people say? Down, right? What would you say? Down. Okay. So guess what? That's exactly what IUL does. That's exactly what IUL does. So make sure you're taking notes. Make sure I'm going to give you my best stuff here today. So make sure that you're applying this stuff. All right, here we go. Next thing I wanted to walk you through, and some of you might have seen this through the LionStar presentation, if that's the one that you're using. If not, get in alignment. Just kidding, not really, right? But let me make sure that we're walking you through this, because I think this paints a good picture of where, how people can understand this as compared to something they may already be used to, like a workplace retirement plan. So think about this. Who's ever had a 401k, 403b, 457, right? Something like that. Who's ever had a workplace retirement plan? Okay, most of us, right? Through your W-2 job, okay? Did you know that those plans they're barely older than me? Okay, I was born in 1980. They were born in 1978. Do you know why? Because tax rates were 70% back then. I want you to think about that. The highest tax rate was 70%. So imagine this. You make $1,000, 700 goes to the government, and you live on 300. Does that sound great? No, right? So wouldn't you wanted to kick the can down the road with taxes so you could hopefully pay less than 70%? Of course, right? So these plans were never actually designed to be America's retirement plan for the average and ordinary person. They were designed to be a tax deferment, an income deferment plan for highly successful executives and business owners. Really? Yes. Right? How do you know that? I read. Surprise. Like I read, right? And I'm going to give you some of these books as well. So let's think about this. You have a gross paycheck and a net paycheck. What's the difference? The gross is pre-tax. The net is post-tax, right? And let's just say someone's saving $500 a month, and into the market, their contributions go. Okay. Now, what's someone's typical retirement goal? Let's say they want to have $1 million saved for retirement. So you have $1 million saved for retirement. Well, let's think about this. Social Security is underfunded. Medicare is underfunded. The government's $39 trillion in debt. What do you think is going to happen to taxes 10, 15, 20, 30 years from now? You think they're going to be a lot lower in the future, or probably higher? What do you think? Probably higher. right? So if they're higher and you retire and take out your money, what does that mean for you? Less money or more money? Less money or more money? Less money, right? Less money, because the government's going to keep more and you're going to get less. You're welcome, right? Which is, by the way, what they want you to do so that they can keep more money, so that they can try and pull down this deficit. Just a word to the wise. So you also have a couple rules and regulations with this, right? And I always ask people, hey, Bianca, on a scale of 1 to 10, let's say 10, you could teach me a class, and 1, you don't know anything. You're just putting money in there. How well do you understand the rules, the regulations, the penalties, the taxes in your plan? I don't say, Bianca, how well do you understand your 401k? And then she goes, I'm a 10, because she just puts money in there every 2 weeks. You get it? Right? You go, how well do you understand the rules, the regulations, the penalties, and the taxes in your plan? And then she's like, oh, the rules, regulations, penalties, none. Right? You know what I mean? Right? Then she doesn't really get it. So then you have to walk them through, right? So let's talk about this. You touch it too early, right? Like this. Touch it too early, you're going to get a 10% penalty from who? The IRS. And by the way, look at me. I don't know if you ever put the word "the" and IRS combined, but it spells theirs. It spells theirs. Yeah, I think they planned that. The IRS. All right. Anyways, right. But no one was laughing on that one. Okay, we're moving on. So penalty 10%, plus you have your federal taxes, plus you have your state taxes. Lesser known is the rule on the high side, which is what? You need to force yourself to take money out. People go, what do you mean? I go, yeah, they force you to take it out, whether you need it or not. By the way, how do you feel about forced to take out your money, right? Does that word forced sound pretty good to you? They go, no, that doesn't sound good at all. I go, yeah, but if you don't take out what they're telling you, you don't get charged at 10%, you get charged 25%, plus your federal taxes, plus your state taxes. So you could be losing over 50% of your money if you don't touch it when they want you to. They go, what? I go, yeah. So touch it too early, right? Penalized, tax. Touch it too late, further penalized, tax. So why do you think people are retiring in their 60s, right? And most people say, oh, to avoid the penalties and taxes. Well, the penalty, yes, but you still have the taxes. So if they stay the same, you're looking at 30, 40%. If they go up, it's going to be even more. Do you guys get that? Not to mention, most people have no idea about the hidden fees they're paying in their 401k. Thank goodness we have a program like GFI Rocket to walk people through that and back it up with articles and videos and the whole deal. So hopefully you're leveraging the resources that we have for you here at GFI. So where I come in is my job is to help people eliminate all these hidden fees, get rid of these pesky rules and restrictions and penalties and taxes and all that stuff, and make sure that they never have to worry about market loss moving forward. Doesn't that sound better? Doesn't that sound better? Yes. So what do we have to change? So the only thing we're going to change is we're going to move to net. And net is, once again, before tax or after tax. What's net? What's net? What's net? Net is after tax, right? There we go. There you go, Karen, right? After tax. Some of you were like, I'm trying to take notes and type in the chat. Austin, you're moving too fast. I get it. It's the Celsius. Don't blame me. Okay. So here we go. Net means after taxes, and we're going to put this into a little account called cash value. Now that account is going to work in an index strategy, which means what, right? Market goes up, you make money. Market goes down, you lock in. Market goes up, you make money. Market goes down, you lock in. Did you see my little hand gestures there? Right? It would probably behoove you to use some of these. Let me do it again. Market goes up, you make money. Market goes down, you lock in. Market goes up, you make money. Market goes down, you lock in. Oh, okay, there we go. Most people are visual learners, right? So you got to be able to do this stuff over Zoom. Now, let's just say the market was doing over 20%. Do you think you're going to make all 20% in this account? Yes or no? Yes or no? You'd like to, but probably not, right? That's why it's not too good to be true. So let me explain. Typically what will happen is you will get a majority of the gains. What does that mean? That means that these companies will either impose a cap or a spread to make sure that they maintain profitability. Because you don't want someone unprofitable backing up your money, do you? No, right? So all you're doing is you're just transferring the risk to the insurance company. Let me tell you what I mean. So let's say you can make 15% in this. Market does 20, you only make 15. You go, oh, that's terrible. I want to make all 20. Okay, Turbo, no problem. What about if the market loses 20? Do you want that one? Oh no, I don't want that one. Oh, okay. So would be losing 0% be better? Oh yeah, that'd be way better. Okay, so here's the question. Closing question coming. Here's a question. Would you rather get a majority of the gains and none of the loss, or all of the gains and all of the loss? Would you rather get a majority of the gains and none of the loss, or all of the gains and all of the loss? Right? And they're going to go majority of the gains, none of the loss. Exactly. By the way, this is average over 9%. You can Google right now, right? If you just Google right now, average returns in 401k, you know what's going to pop up? 5 to 7, 5 to 8%. If you Google average returns in IUL, you know what's going to pop up? 8 to 12%. So everything I'm talking to clients about during presentations and things like that, they can just Google it. They don't have to believe me. They can believe Google. Okay. So it's fine. Right. But let's think about this. We have to use and put insurance on your money, but not any type of insurance, specifically life insurance. Why? Because of the tax codes. If you don't know tax code 7702A, 72E, and 101A, let me say it again, 7702A, 72E, and 101A, I recommend you look into those 3 tax codes because that's what's backing up all these benefits. Did you know that 401k is a tax code? Did you know 403b is a tax code? Did you know 457 is a tax code? And what are tax codes? Tax codes are just rules that tell you what you can or can't do with your money inside. That's all tax codes do. They're just rules that say what you can or can't do with your money inside. Now let's think about this, right? Because this program comes with a lot of perks. The first of which is protection. 3 ways: protection for your family, protection from any future taxation, and protection from any market risk. But that protection is like a roof over your house. Let's just say, for example, we remove this roof and all your stuff's inside and a storm comes by, right? Mario's in Tennessee, a tornado comes by, something like that. You have no roof. What happens to all your stuff? What happens to all your stuff? Ruined, damaged, terrible, right? Does that make sense? Gone. Exactly. So we have to have the roof on there to protect us from all these negatives. Does that make sense? And then think about emergency funds. Let me ask you a question, John Coakley. Are you the type of guy that wants a lot of restrictions on your money or flexibility with your money? Flexibility with my money. Okay, so that's why you can use this for any emergency fund. Let me ask you, Dan Lohman, would you rather have a taxable retirement or a tax-free retirement? Oh, a tax-free retirement. Okay, perfect. Let me ask you, Venus Sledge, right? Would you rather save for your kids or your grandkids in an account that's flexible and doesn't count against college financial aid, or something that's very restrictive and can only be used for one purpose? Oh, flexible. Interesting. Okay. And then remind me, Lissandra Lopez, what is it that you were earning at your bank account again, since you're putting all your savings there? Oh, 0.003. Okay. Well, wouldn't it be better to be averaging over 9%? Oh, okay. Perfect. So imagine all of this money that you need to take out comes out 100% tax-free. And guess what? Magically, we're talking about here. IUL. So let me ask you a question, Lauren Olivares. If you were to be offered this at your job, would you, knowing what you know now, would you rather choose the one on the top or the one on the bottom? The one on the bottom. Well, the good news is you still might be able to do that. The bad news is it's not offered through your job. So that's why we believe in owning things outside of work, so you have more options. You're not opposed to more options, are you? Boom! Are you guys catching some of this? Oh my goodness. All right, this is good stuff. So check this out. One of my favorite examples, and we're going to just do a 401k to IUL comparison. And if you are not using GFI Rocket, I saw someone say, is GFI Rocket Agency Rocket? Yes, it is, but we branded it, right? GFI Rocket. Okay. So if you're not using this for your client comparisons, you're totally missing the boat. All right. You're totally missing the boat. So let me explain. Let's just say someone's around 30, 31, and they start saving in their 401k 15 grand a year. 15 grand a year. Okay. 15 grand a year. But remember, with the IUL, what do we have to use? Pre-tax or post-tax? Post-tax, after tax, right? So now we're going to do what? We're going to take out the taxes up front right here. So we pay our taxes up front, which, believe me, saves you a lot more money in taxes, as I'll prove to you, right? So 12,000, just to keep things apples to apples. Because if we showed 15 in an IUL, that's not really fair. Does that make sense? Because remember, you have to pay the taxes. So this is like the most fair comparison you will ever see. So for those of you that don't have an IUL, that you're still in love with your 401k, please pay attention. Please pay attention. All right. So let me talk about fees. Let's just go ahead and get rid of the elephant in the room right away. Okay. If I were to ask you in an account that you're saving for your future, would you rather pay $400 a year in fees or $2,000 a year in fees, Barbara Rohr? Which would you choose? You would choose 400, right? You would choose the lower. Like, who wants to pay extra fees? No one, right? We're not idiots. Okay. So guess what? You're going to pay $400 and I do the same. Second question, Barbara Rohr. Are you using your 401k to save 1 year, pull all the money out and then spend it? Or are you saving over a long term? You're saving over a long term. So wouldn't it make sense then to compare everything over a long term? But IULs have high fees. Compare over a long term. All right, you're catching it. Good. By the way, heaven forbid anything happen to Terry King here. His family's going to get the after-tax leftovers. Hear me how I said that. The after-tax leftovers. You know what that sounds like? Like, you just get the after-tax leftovers, Terry. Right? Like the after-tax leftovers of 12 grand versus Terry's family over here, heaven forbid anything happens, gets 510,000 tax-free. So let me ask everyone a question. Which would Jody prefer, right? Would Jody prefer 12,000 after-tax leftovers or 510,000 tax-free? If you said 510, you know Jody. No, I'm just kidding, right? Which is awesome, right? But check this out. Not only that, but what if Terry was to get sick with a critical or chronic or terminal illness? Did you know Terry's going to be able to touch about 90% of that 510 up front if he needs anything for that? That's huge. So wouldn't it make sense that it's okay to pay a little more up front for that extra peace of mind? Does that make sense? Does that kind of explain why initially maybe it's a little more because you're getting more value, because you're getting more benefits? Okay, good. Now let's talk about you save for your retirement. Now you're 65. Congratulations. You're about to retire. You've put 525,000 in your 401k. You've only saved 420 in your IUL because remember we paid taxes up front, but look at what you're on the hook for here. You're on the hook for $213,000 in taxes, Mark Garcia. And let me ask you the question, right? Because remember, no taxes over here. We already got rid of that up front. Mark Garcia, now that we've looked over the whole time, would you rather pay $394,000 in fees or $54,000 in fees? Oh, you're very smart. $54,000 in fees? Okay. Who would pick $394,000? No one, right? You get it? No one, right? So $54,000, do you see why the benefit is there now? Okay, but good job, Mark Garcia. Saved $1 million in his 401k, no problem, right? But he's also saved 1.3 million in the IUL. Which would you rather have? 1 or 1.3? 1 or 1.3? Okay, very good. And then let's talk about this, Bob Goddardson. You can either get the after-tax leftovers of $852, heaven forbid anything happen to you, or your family can get 1.8 million tax-free. 1.8 million, right? Are you guys getting this? Are you guys getting this? All right, good. So let's talk about the fun part. You retired. You retired, Johnny Brown. You retired, right? 66, let's say, okay? And guess what? We got to pull out 148 grand to retire on 119. So you know what that does? That puts us in a $148,000 tax bracket. You know what that affects? Social Security, Medicare, all that stuff. You know what we do over here? We pull out 119 to get 119, but we already paid our taxes. So how many taxes are assessed on our 119? 0. So let me ask you a question, Johnny Brown. Would you rather be in a $148,000 tax bracket or a 0% tax bracket? 0% tax bracket. Very good. So let's look at this now. Now you retired, you lived on that money, but Damien, what happened? You ran out of money, brother. You ran out of money in 9 years. So let me ask you a question, Damien. At 75, would you rather be planning your next vacation or writing your next resume? Oh my God, planning your next vacation, right? Oh my gosh, do you guys hear these? I hope you're getting all these questions. This is good stuff right here, right? Writing your next resume. That's why they say the new retirement is a part-time job. Because most people, because of lack of education, they've saved what their employer told them to do, and then they ran out of money and they have to go back to work. Right? I have a lady that I'm field training in my base shop right now, and her crusade story, she's like, I used to work at Lowe's. I used to work in the flooring department. And guess what? There were guys 73, 75, 77 working with me. And they were sharp people. And I just asked them, like, why are you here? And they're like, we ran out of money. Right? So think about that. You're 77. You're having to go back to work. Terrible. Terrible. Okay. But what if you could retire on 119,000 tax-free all the way to age 90 or beyond? Would that be better? Not only that, you have 358,000 at age 90 to pass on to your family. Once again, tax-free. Say it with me now. Tax-free. Have you noticed when you say tax-free, you smile? Have you noticed that? Tax-free, tax-free, right? Tax-free, right? But when you're like taxable, right? And then you kind of frown, like taxable, right? Have you noticed that? Okay. Anyways, right? Just side note. Okay. So let's think about this now. Okay. Let's think about this. So we put in 420. We took out a total of 3.3. So let me ask this question, Bruno Buchanan. If you wrote us a check for 420,000 and we wrote you a check back for 3.3 million, would that be a good deal or a great deal? And that'd be like a great deal, right? I mean, how many times would you want to do that? All day and twice on Sundays, right? All day and twice on Sundays. So that's what I'm talking about. So let's think about this. Who now kind of sees the light on 401k versus IUL, on tax deferment versus getting rid of your taxes up front, on having higher fees initially because you get more benefits, on not outliving your money, on not having, any tax bracket in retirement? Like, wouldn't that be a lot better? Like, who's going to say no to that? Does that make sense? But do you explain it that way? That's why Mario had me talking to you here today. All right, good. We're about halfway done. Let's keep it moving. So think about this. I want to shift gears here because we talked about protection. We talked about tax-free retirement, but we also need to discuss family banking, infinite banking. But in order to do that, you first have to understand, how do the banks really work? Because most people have no idea. They put money in there, but they have no idea how it works, right? So how does this actually work? Well, let's just say you're the client, right? You go down to your bank, Wells Fargo, Chase, B of A, whatever, right? And you're going to put your money in the bank. And the banks are backed up by what? What we call FDIC. Do you guys know what that stands for? FDIC. It stands for Funds Don't Increase Correctly. No, I'm just kidding. It doesn't stand for Funds Don't Increase Correctly. It's actually Federal Deposit. I was just seeing if you're awake. Federal Deposit Insurance Corporation, right? You got it. Federal Deposit Insurance Corporation. And they're going to back you up to $250,000. They're going to back you up to $250,000 in total at that financial institution, not per account, in total at that financial institution. Now let's think about this, right? What is Federal Deposit Insurance Corporation doing? It's insurance for the bank's money. Okay. So now what are the banks doing? They're putting their money with insurance to back you up, Mr. or Mrs. Client. And think about this. The banks are working off 1 to 10 ratios. What does that mean? That means for every dollar you put into the bank, right, they're lending out 10 times that amount. They don't have the money. Let me prove it to you. Who remembers, I think this was 2022, maybe 2023, something like that. You remember like Silicon Valley Bank going under? Like this is just recently, right? You guys remember that? Like in the news, right? And all these banks that were going under. There was like another one in like New York was going under, all that stuff. You want to know why? Because people said, give me my money. And they said, we don't have it. That's what they said. We don't have it, right? So then the bank had to shut down. Let's think about that. They don't have your money. I mean, what do you think they do, Andrew? Wrap it up in a nice little red bow, set it on a shelf, and wait for Andrew to come back and get it? No, right? They're taking that money and they're making money. Yes or yes? Absolutely. So let's think about this. The insurance corporations are working 10 to 1, meaning what? They have 10 times the amount in reserves as they do in obligations. So let's just think about this logically. Do I want to put my money with someone who's gambling on a house of cards, or someone who can actually back up my money? Which is why the bank puts their money there. Are you guys getting this now? Are you guys getting this? So what do the banks give you? Your little 0 to 1%, your little pittance, right? Your little pittance. Thank you for playing. Okay. And guess what? If you make over $10, they're going to send you a freaking $10.99 on that puppy, right? Oh, thank you for making $10. We'd like 3 of those dollars, right? Are you kidding me? But that's how it works. Anyone ever get one of those 1099-INTs before, right? Tax season, you know what I'm talking about. Okay. So let's think about this. But then what are they going to do? They're going to take that money. They're going to lend it back to people like us, guys. And they're going to charge us what? 0 to 1? Oh, no. They're going to charge us way higher, right? Because they're in the business of profit, just like the business you should be in for your own business. So let's think about this. Credit cards, 18 to 30%. Student loans, 8 to 10. Auto loans, 4 to 6. Shoot, now that's probably like at 7. Okay. Mortgages, 6, 7, right? That might even be 8. Okay. So think about this. They give you your little pittance, and then they're going to invest the profits and make way higher returns. They're also going to take those profits, reinvest it here with insurance, on average earn 6 to 12%, but do it 100% tax-free. Remember, 100% tax-free. They call it BOLI. We're going to talk about that. They call it BOLI. And so all you're going to be able to do with your clients is show them how to cut out the middleman. Hear me. All you're going to be able to do with your clients is show them how to cut out the middleman, go direct, okay, where they can earn the 6 to 12% and they can grow and access their money tax-free. And then guess what? When they need it, they can take it out from their self, right? 100% tax-free. No questions asked. Just able to do it, no credit checks, no nothing like that. And that's called infinite banking. Who's ever seen this before? Right? Some of you never seen this before. You're like, is that how my bank works? Yes, that's how your bank works, by the way. Okay. So let's think about this for a second. There's a book out there that if you have not read it, this is like fundamental for your crusade getting up and your conviction getting up. It's called Money, Wealth, Life Insurance. Money, Wealth, Life Insurance. Please read that book. I hate reading, and it's only 66 pages. I can get through it in a couple hours, and I'm very slow reader. Okay, very slow reader. Right? That's like me. Okay, so if I can do it, you can do it. But let's think about what it says here in this book, Money, Wealth, Life Insurance. It says, follow along now. Here's reading time. Buckle up for the story. All right. Cash value life insurance plays a massive role in financial institutions, corporations, and banks. More than you could ever imagine, these organizations buy life insurance by the billions and use it for different reasons. Not only does it increase their financial stability and reduce their taxes, wink, wink, nudge, nudge, it is an ideal place to fund employee pensions, healthcare costs, and other benefits. It's so common among banks and corporations, they even give it its own name, bank-owned life insurance. There it is, BOLI. And corporate-owned life insurance, COLI. Look at this. This was a few years back. I think this was around like 2015. This is how much in these banks they had by the billions in life insurance. So you're thinking, but I bank with Bank of America. Yeah, and they had 20 billion. Okay. But I have Wells Fargo. Yeah, they had 17 billion. I use Chase. Yeah, they had 10 billion. Okay. Look at the banks are in the business of money. Okay. They have some of the greatest minds in the world, economists, attorneys, accountants, financial analysts, other advisors, helping them do what? Increase the efficiency and use of their capital. Let me ask you a question. What are you doing to increase the efficiency and use of your capital? Ooh, that's a good one. That's a good one. Okay. It's not insignificant that banks place billions of dollars in life insurance. It's a reflection of the value they place on this powerful asset. For banks, it provides the ultimate in safety, stability, and growth. And more importantly, the FDIC allows this to be classified as what? Tier 1 capital, the safest capital a bank can have. Well, is this true? I mean, I know it's in a book, but like, is it true? Okay, here's the next thing. Google usbanklocations.com and sort it by life insurance assets. I literally just pulled this up right before this training. I put this on here. This is ending the year, last year, 2024. Wells Fargo has 18 billion of life insurance assets. JP Morgan has 12 billion. PNC, 11 billion. US Bank, 7 billion. Truist Bank, 7 billion. Citibank, 5 billion. Bank of New York Mellon, 4.7. BMO, 4.4. State Street Bank and Trust Company, 3.8. Regions Bank, 3.5 million. So, are you on here? But yet you keep giving your little money to the bank instead of going to where the banks put their money. How does that make sense? And just in case you don't know, these are all the corporations taking advantage of it. Shoot, even Mickey's got his money here. Are you kidding me? Right? Walt Disney? All right, here we go. So how are the banks making money? Just to recap, by the circulation of money. Circulation of money. They're taking in deposits. They're paying you a small amount. They're lending it out at highest interest rates. They're profiting. So how does it work for you? You're going to make your deposits, except to your own insurance bank, your family bank. Yeah, you're going to have a small cost of insurance, kind of like what they're paying you, right? Very small. But then everything net of that is going to go towards building your family bank. And then what are you going to do? Well, you're going to lend out the provider's money. Whoa. Time out. Did you say provider's money? I thought it was my money. Oh, your money's in there making you money. But when you go to use the money, you don't actually use your money. What do you mean? Yeah, they're going to give you their money to go make money. Really? Yes, I'll prove it to you. It's called leverage. I like that, Terry, right? It's called leverage. So you're going to go invest that to what? Make more money, build wealth. So let's think about this. Everyone has a checking and savings, right? Checking and savings. Yes, we have that. What's the benefit of your savings account? What's the benefit of your savings account? You can touch the money. It's quote unquote safe, FDIC, yes or yes. And you can stop putting money in at any time, right? Like there's no required contributions, right? Okay, what's the downside? You're taxed on the small interest you earn, very low interest rates, and you have no protection. That's the downside. So how does that compare to your family bank? The cash value is liquid. You get death benefit and living benefits. Remember the Terry King example I just used, right? The death benefit's tax-free. The cash value grows tax deferred. You have protection, lawsuits, bankruptcies, and it's not affected by market downturns. Remember, if your money can go up, down, or sideways, which would you eliminate? Down. Boom. That's what we're talking about. What's the downside then? People like you not knowing how to structure them. Hear me. People like you not knowing how to structure them. You hurting people, right? We always say, we can't hurt people in our industry. Yes, you can. If you don't know what you're doing, you can. Absolutely. So guess what? That's why it's better to match up, do it with someone who knows exactly what they're doing, learn from them 1, 2, 3 times, and then the rest of your career, you're good to go. Why do you think we have a field training program? So we don't send people out there willy-nilly, not knowing what to do. So to get the full benefits, you got to be in there a little bit a while, right? And you got to build it over a few years. So how does it actually work? Now, most people are visual. That's why I put this in here. So you can visually see how does this actually work, okay? So let's think about this. Joanna Rafa opened their family bank, right? It's the Gonzalez Family Bank. Okay. And they're covered for $500,000. That's the insurance amount. And they have cash value in there of 50. What's cash value? Write this down. That's your money making you money. That's your money making you money. That's your money making you money. People go, well, the cash value is, it's your money making you money. Like understand how to like talk about things in a simplified manner. It's your money making you money. Okay. So then what's the loan value? How much you can touch, how much you can touch. How much you can touch. Okay. So what's the cash value? Your money making you money. What's the loan value? How much you can touch. So what's the family bank determined by? Your money making you money or how much you can touch? How much you can touch. Does that make sense? How much you can touch, AKA the loan value or surrender value. Okay. The loan value or surrender value. All right, good. So let's keep it moving. So check this out. I read this book called What Would the Rockefellers Do? Write that down. What would the Rockefellers do? What would the Rockefellers do? Anyone know the Rockefellers? They've stayed billionaires with a B, but billionaires for 7 generations in a row now. Longest in US history. 7 generations, but billionaires. Okay? So what does it say in that book? It says, when you pay cash for big purchases, the compounding process is interrupted. Write that word down, interrupted. Okay. However, when you pay for those same purchases using a cash flow insurance policy, AKA Family Bank, Infinite Bank, the compounding process is not interrupted. So write this down. UCI, UCI, UCI. What's UCI? Uninterrupted compound interest. Write that down. Uninterrupted compound interest. Uninterrupted compound interest. By the way, anytime there's a negative, you're automatically interrupting the compound process. Well, I get compound interest in my 401k. No, you don't. No, you don't. Because anytime there's a negative, anytime you lose money, you have to make it back to then go positive again. That's not true compound interest. Compound interest only happens at 0% or higher. What do IULs do? 0% or higher. You guys with me? You guys with me on that? All right, good. So let's talk about an example. Raise your hand if you've ever bought a car. Raise your hand. Raise your hand if you've ever bought a car. All right. So most of us, some of you have never bought a car. Wow. Who bought it for you? Mommy and daddy? All right. Okay. Here we go. So who bought a car? Okay, good. So most of us bought a car. All right. Now let's check this out. Let's talk about the most common ways people go about buying a car. So what do? Well, one of them is, I don't have any money. I'm broke. That's the most common way, by the way. I don't have any money. I'm broke, but I want this car. Have you guys ever seen Willy Wonka and the Chocolate Factory? They're like Veruca, right? They're like, I want this car now, right? Like, you guys know what I'm talking about? I want an everlasting gobstopper now. All right. Anyways, right? You guys are with me on that? Okay, good. So the pros is what? You can walk off the lot with the car. Like, you don't have to have some big old, upfront investment. You could just put a loan, like small down payment, right? You can get financing, right? Now you got to qualify. So what's the downside? You got to qualify. So what does that mean, right? You don't own the car. Yes, I do. I drove off the lot with it. Yeah. Try and miss a couple payments. See if they don't try and come get the car. You don't own it. All right. The bank owns it. Okay. So what does that actually mean? Well, you're going to be charged interest. You're going to pay more or less for that car over time, more or less, more. You're going to pay more for the car, because you're also tacking on additional interest. Hear me? Application qualification. You have to have decent credit, good debt to income ratio, fixed payment schedule. Have you ever tried to throw down a lump sum on your car payment? Did your next month car payment change? No, right? No, it didn't, right? So think about this. I'm going to throw $2,000 down on this $10,000 loan I have outstanding. Well, next month, you're still paying $403.76 or whatever it is, right? So it's a fixed payment schedule, and you get a credit ding if you ever miss a payment. You get a credit ding if you ever miss a payment. That's what most people do. Okay, let's talk about one maybe smarter way. I'm going to do cash. I'm going to save. Cash is king, right? I'm going to do cash. Okay, what's the benefit? You own the car. You drive off the lot, it's yours. No outstanding loan. What's the downside? What else could you have done with the 30 grand? What else could you have done with the 30 grand? What if you didn't have the 30 grand right now to buy the car? You're going to have to save up for the 30 grand, which is now what? Delayed gratification. Delayed gratification. Do you think the car is going to cost less or more 5 years from now, 3 years from now, 7 years from now? More. Hello, inflation, McFly. Are you getting it? Right? Inflation. And you're going to be saving it where? Probably in a bank where you're going to earn 0.003. So you're going to be getting wiped out due to inflation. But let's talk about doing it the smartest way, using your family bank. So now the benefit is you still own the car. Your money stays in your account making money. Because whose money is it that you're using? Your money? No, the insurance company's money. The insurance company's money. So wait a minute, you're telling me that I do business with one of these providers on GFI and they're going to buy me the car? Yes, if they see you can back it up. If they see you can back it up, they're going to give you their money and you're going to go buy the car. Isn't that crazy? Insurance companies buying you the car? Anyways, no application, no qualification. Who determines the payback schedule? Who's the bank in this situation? You. So what if you don't want to pay it back for 3 years? You don't have to. What if you don't want to pay it back for 5 years? You don't have to. What if you want to pay it back the next day? Sure. You're the one that determines how quickly or lengthy you're going to take to pay it back, if ever. If ever, by the way. No credit check, no dings, penalties, credit. The only downside, hear me, the only downside is you have less available for your next investment or purchase. You have less available in your family bank for your next available purchase. Does that make sense? All right. So how does this work once again? So let's go over this. We have 500,000, the insurance wrapper. We have the cash value, AKA money making me money, right? Money making me money. Okay. We have the loan value, AKA how much we can touch, how much we can touch. And then we took the loan from the insurance company. They gave us their money and we're going to use this to go get the car. So let's look at this now. Let's look at this. All right. So we have Sylvia. She just did this. She bought her car, right? Sylvia Mendoza, you just did this. You just bought your car. You were 500,000. You took out the money. Boom. Okay. First scenario, you die. Sorry, Sylvia, you're dead. Okay. You die. That's the first scenario. I know it's not very exciting. And guess what they do? They go, well, we owed Sylvia's family 500 grand, but Sylvia owed us 30,000. So you know what we're going to do? We're going to give her family the leftovers. We're going to settle up upon her death, and Sylvia's family gets 470,000 tax-free. That's how that works. Now, I can't get too excited about this one because you have to die for it to work. Okay, you get me, right? So let's talk about if you live. Congratulations, Sylvia, you're back alive. Okay, so Sylvia's lives now. She's got 500,000 in insurance. She has her cash value. She is going to be disciplined and pay this back as if she took a regular loan from a bank at the dealership, and she's going to pay herself back. And so that 30,000 is going to get paid down over, let's just call it 5 years. That's going to go to zero. The cash value, AKA money making you money, is going to make you money over the next 5 years, 7 years, 10 years, whatever the case may be. And it's going to work something like this. And now you have more money in there. Did you catch that? Let's look at it again. The loan gets paid off. You continue to make money and it works something like this. Did you get it? One more time. I don't think you got it. Okay, it works like this. The loan gets paid off. You make more money in your account and it looks something like this. Did you get it? Did you get it? Awesome. So what are we really talking about? We're really talking about how do you take $1 and with that $1, you make it valuable as 2 or 3 or even more dollars. How do you multiply these dollars? How do you get $1 to use for multiple things at the same time? Let's think about this. You're in business, right? So Estella Valdovinos, right? What she does, let's just say, this is not really what she does. I'm going to use her as an example, but let's just say she goes, hey, I have this family bank. I'm going to run this contest for my team. And she runs this contest for her team. She takes out, I don't know, 10, 20, 30 grand, whatever it is, depending on how nice she is, right? And she takes out this money for her team and she runs this contest. And this contest has recruiting and production and qualifications and metrics and all this stuff. And through that, her and Bianca generate, let's call it 50,000 in profit in their business. So she took out 20 grand. She generated 50,000 in profit. And then she took the 50 and she paid back the 20 grand and now she profited 30 grand. Would that be smart of her? Yes, that would be smart of her, wouldn't it? Right? What about even acting as a lender? Think about this. Hard money loans, what can you get on those? 10, 12% these days? So think about this. You're going to take the money out. They're going to charge you a small amount of interest. You take it, you lend it out to someone else who needs it. You charge them 10 or 12%. Now you're double dipping. You're double dipping. Double dipping. Did you get it? Did you get it? All right. What about investing in real estate? I want to get in real estate, right? Like everyone and their mom. Okay. So that's fine. But think about that. What if you took this, you put it there, the renters paid back your mortgage, or the property went up in value, equity, right? All while you just took that money from the profit in real estate and paid back your family bank loan. But you didn't take the money. The insurance company bought your real estate. Wow. Is this too much? Is this too much for you guys? Because I know it's a lot. Mario said, give them everything. I said, everything? He said, everything. I said, all right. I don't think they're ready, but here we go. All the while, what? UCI, uninterrupted compound interest. Yay! Right? So let me prove to you this works. Here's a personal example, guys. Full transparency here. This is my money. Full transparency. This is my money. Oh, everyone's cameras came back on for this one. That's interesting. All right. So here we go. I needed 73 grand as part of the $300,000 down payment for this house I'm speaking to you from. Okay. So I have 11 of these policies. 11? We'll get into that later. 11 of these policies, right? And guess what? I took 73 from this first one. Did they charge me money? How much did they charge me? Someone put it in the chat. What did they charge me to go use the insurance company's money? 4.4%. Is that a pretty good rate, guys? 4.4%? Who would like that right now? People are like, heck yeah, right? 4.4. Okay, so this is my $5 million. This is one of 11, just so we're clear. This is my $5 million policy for me and my wife. $5 million. $5 million. All right, $5 million. And how much do I have? What's this here? This is my money making me money. You guys with me still? This is my money making me money. And then what did I do? I took out how much I could touch, right? Money making me money, how much I could touch, money making me money, how much I could touch, right? I took that out. And then guess what? I determined when to pay it back. So if my 78 grand, and by the way, I just looked up my accounts. I just made 22% in this one account. What were they charging me again, guys? 4.4. And I just made what? 22? Who would take that deal? Oh my God, everyone would take that deal. So think about this, guys. Has this year been volatile? Yes or no? Has this year been volatile? Yes or no? 2025, it has been pretty volatile, right? So here's the benefit of IUL. When times are bad, people don't even care about making money. They just don't want to lose. You with me? So it's called when times are bad, people want a return of capital. Okay, write that down. Return of capital. But when times are good, what do people want? They want cash money. They want a return on capital. So when times are bad, they want return of capital. When times are good, they want return on capital. Well, with IUL, you get both. Let me prove it to you. These were some client statements. 10.92%. But I heard IULs don't make money. 41%. 41%. 9.7. 16%. Obviously, names withheld, right, for compliance purposes. Okay, what about a downturn? So 8.2. What about this one? 0. Aha! I knew it. You didn't make any money in your IUL. Yes, it did exactly what I told you it was going to do. It didn't lose money. I didn't have a negative. So meanwhile, you lost 20%. I lost 0%. You lost 20. I lost 0. Who would you rather be? Right? You guys with me? All right. So where do we find this magical money for family banking? Where do we find this magical money for family banking? A couple more minutes. Checking, savings, CDs, dead money, as I call it, quote unquote, dead money. Because what's that money making them? Like peanuts, right? It's making them peanuts. Okay. So dead money, you can find it there. What about money they're throwing into like a taxable brokerage account every month? That's variable, right? That's volatile. You can redirect some of the funds there. What about my 401k money I'm putting in there? And you just proved to me I would be way better served to have an IUL through GFI Rocket. Yes, we can redirect those 401k contributions there. What about my cash flow producing assets? What if I have real estate? What if I run a business? What if I do something like that? Great. Take those profits, leverage that to build your own family bank. So guys, in closing, let me give you a couple additional resources. Okay. As if I didn't give you enough already, but let me give you a couple additional resources. Leaders are readers. Write that down. Leaders are readers. I hate reading. I hated reading. But then someone said, well, what if you read to get rich? I said, well, I'll do it for that. They said, what if you could read to be a better husband? I said, sure, I'll do it for that. They said, what if you could read to be stronger in your faith? I said, yeah, I'll do it for that. They said, what if you could read to be a better dad? I said, sure, I'll do it for that. They said, what if you could read to be better with your business and a better leader? I said, yeah, I'll read for that. Right? So I used to hate reading because it was for a letter grade that frankly didn't mean anything. Now I like reading because it actually moves me ahead in life. 5 Fs, right? So what are you doing to increase your self-development in these specific areas? So let me give you 3 options. Power of Zero, how to get to the 0% tax bracket in retirement, the Retirement Miracle. If you want to know some of the technical stuff, but easy to explain, how do the index strategies work? How do they do that? I just made a social media video on that. You could just use that, or you just read the book. Okay. But either way, and then Family Bank Strategy. This one's gold, right? Because you know why? It's the only book. I've read 30 books on this stuff. It's the only one that talks about whole life and IUL and why they're both needed. Whole life and IUL and why they're both needed. You should read that book. You should read that book. Knowledge is power. Nope. Knowledge is power if it's applied. If it's applied. So let me give you some power questions how you can book more family bank appointments. Okay. Let me give you some power questions. Number 1, Gabby Torres, would you rather put your money in the bank or where the bank puts their money? What do you mean? Oh, well, let's get together real quick so I can show you how that works. I'm going to give you my closes. Here we go. Right? Here we go. All right. Next one. Wanda Lewis, how would you like me to show you how to use the same dollar twice? How do you do that? Great question. Let's get together real quick so I can show you how that works. All right. Next one. Sean Timmons, what if there was a way to never stop compounding on your money, even if you use it? What do you mean? That sounds too good to be true. Is it? Is it too good to be true, or have you just not heard of it yet? Oh, come on now. Come on now. Is it too good to be true, or have you just not heard of it yet? Oh, come on now. All right. Next one. Wilson Wong. What if you could take loans against your money and never have to pay it back? What? You can't do that. Really? Let's get together real quick. I'll show you exactly how that works. Okay, book it. Book it. Book it. Oh, are you seeing how we're on so many appointments? Good. So what's in it for you? Because that's what everyone's radio station, everyone's favorite radio station, you know what it is? WII-FM. Write that down. WII-FM. What's that? What's in it for me? That's everyone's favorite radio station. What's in it for me? All right. So let me tell you what's in it for you. You do something where we're just keeping the crusade alive, protecting people's families, putting insurance and living benefits on them. And you set up an IUL at $200 a month. And that's going to be $2,400 target premium, because something like that, you're usually doing full target. And guess what? As an associate, you're making $1,100 net license. Done. Right? Just a little insurance protection. Okay. Senior associate making $1,200. My MDs, money doctors making $1,400. The SMDs, $1,700, or the EMDs, $1,900. Okay. Almost 10x. See why we want you to be an EMD? Because you make like 10x what you help people save. Anyways, right? No, don't know if you caught that. Okay. Or what you do, you go, that GFI Rocket example, Austin, was amazing. I'm going to go do that with everybody. Okay. So now your target premiums go up. You're doing 12,000 target. Maybe they're saving 1,500 a month, 1,200 a month, 2,000 a month, right? Something like that, right? They're just overfunding. They're saving for retirement. And let's just say your target premiums around 12,000. Well, as an associate, wet behind the ears, you're going to make $5,400 as a little associate. Okay. If you're a senior associate, where my essays at? Not my essays, but my SAs, right? So where my essays at? All right. 6,000, right? Money doctor, 7,200. SMDs, 8,400. EMDs, almost 10 G's. What? Gotta get to EMD, guys. Or what about this infinite banking? You know, the largest client that I ever helped, largest premium client, not largest client, that probably wouldn't get approved, right? But largest premium client that I ever helped was $250,000 a year. It was a doctor. They put $250,000 a year into their family bank, and that was $100,000 of target premium. I made a little over 50 grand. This was at the practice company back in 2020. And my little associate I was training made 30 G's. What? Yeah, 30 G's. Crazy. Okay. So imagine you're helping someone set up a family bank, or you're not knowing what to do, but you leverage one of us, matchup system, and then we help you close it, and you're making 11,000 split or 22,000 yourself. You're making 12,000 split or 25 grand yourself. You're making 15,000 split or 30 grand yourself. You're making 17,000 split or 35 yourself, or you're making 20,000 split or 40 G's yourself. How'd you like to wake up on a Tuesday? 40 G's. How'd you like to wake up on a Friday? 40 G's. Right? Wouldn't that help you with a few things? Heck yes. So here's my challenge. We got to shoot for the moon in June. Well, I don't have a gazillion appointments to go on. I get it. Okay. But knowing what you know now, don't you think you can at least go back to people? Because I know what you're thinking. You're thinking, well, I did a field training appointment. We didn't talk about any of this. Yeah, I know. That's why Mario's having me go through it. Right. So guess what? Circle back. The fortune's in the follow-up. But you could shoot for the moon in June. And I want to challenge you to help 5 families with just one of those little protection IULs, right? 100 a month, 200 a month, something itty bitty. You could do that, right? You could do that on your own, right? You could do it. Or I want to challenge you to do 3 tax-free retirement IULs. Tax-free retirement IULs. Maybe someone's saving 500 or 1,000 or 1,500 a month. One of those tax-free retirement IULs with GFI Rocket. Right? And then I lastly want to challenge you, whether you can do it on your own or you need to match up, but let's set up one family bank this month in June. One family bank this month in June. Think about this. If you help 5 families do this, 3 families do this, and 1 family or business owner do this, what are you going to make in June? What are you going to make in June? Right? You know what you're going to make in June? Little associate, probably going to make 30 grand in June. You know, you're going to make MD, probably going to make 60 G's in June. Who would like to make 60 G's this month? You know, you're going to make SMD, you're going to make probably 75 G's in June, right? EMD's 100 grand, 100 grand. Easy peasy, lemon squeezy. So here's my Instagram. Here's my number. Text is easiest. I'm usually on a bunch of appointments, so hard to pick up a call sometimes, but shoot me a text and I'll be able to get back to you, or you can feel free to leverage me for any of these appointments. But there's a lot of great EMDs on this call that know what to do, that have done this stuff in the past, that understand all this, that conviction's high. They walk the talk, they talk the talk, right? They live this stuff. They have policies. They know how it works. They've taken loans. They get all this stuff. All right. So match up with one of them and let's all shoot for the moon in June. Thanks, Mario. Back to you, bud.
Boom, boom, boom. Everybody give it up for Austin Harwood. Man, was that a masterclass or what? Was that a masterclass or what? Hey, is what we do for people pretty awesome? Don't more people need to know? The answer is yes. So I want to challenge every single person to take on Austin's call to action. And not just that, let's read the books. I will tell you, if we are a well-read team that has conviction, we will become the best team in financial services. It's not just do we have the most people, it's do we have the most convinced people. I don't know if anybody's ever seen the video of the movie 300 when the other group wanted to join forces with them. And he's like, you're only bringing 300? I'm bringing 1,000. He said, yes, but, and he goes, hey, soldier, what's your profession? I'm a locksmith. Hey, you, what are your profession? Oh, I'm a teacher. He goes, you see? Spartans, what is your profession? Oh. He goes, you see, you brought 1,000 people dressed as soldiers. I brought 300 soldiers. And I want our team to be that in financial services. I want our team to be the one that we know what we're offering. We do the right thing for clients. We go and correct all these injustices. We fix all these wrongs that are out there. And we're not going to do it if we don't take this business from our head to our heart. If we truly are professionals, like I believe we are, we got to become pros at what we do. Like I just picked up that I have not read the last book that Austin recommended between Whole Life and IUL. You know what I just did? And I can't make it up. I literally just ordered it through Amazon and it was $24.95. And I just bought it. I just bought it right now. You want to know, by the way, right here, Amazon, your Amazon order, right? I just bought the book. Why? Because I'm going to work on my craft. The biggest room in my house is the room for improvement. So tonight we are going to have a crazy campaign for June, July, and August. Crazy campaign. You do not want to miss it. So make sure everybody logs on for Millionaire Monday. We are putting some awesome campaigns and awesome, we call them campaigns. Let me just be honest. They're contests. We have some awesome contests going on for this month and for the next couple of months. So make sure everybody tunes in on Millionaire Monday at 6 p.m. Pacific Standard Time. The entire GFI board is going to do it. We're only going to be doing Millionaire Mondays once a month from here forward. So you do not want to miss it. So once a month. So I expect every single person that was on this morning to be on tonight as well. There's probably going to be 2,000 to 3,000 people since we're not going to do them every month. And since we're announcing the contest of the month. So everybody, please log on to Millionaire Monday tonight. And with that being said, Austin, thank you so much for the training. Everybody, like my daughter said, let's pretend we're a rocket ship. Let's shoot for the moon in June. Let's shoot for the moon in June. Let's help a lot of families. Let's grow our businesses. And let's have a super productive week, everybody. God bless and take care.